I'm really pleased to be joined by Brian Dress today. So a big welcome to you, Brian, and thank you for joining me.
Thank you so much, Tony. It's great to be here with you and your audience.
You're more than welcome. Brian is the Director of Research at Left Brain Investment Research in Chicago. So Brian, please tell us more about you, the work that you do at Left Brain, including your passion for financial education and investing. There's one other thing I probably would like to hear more about as well is how you as a firm create, build and preserve wealth for you and for your clients and their families and whatever strategies that you use. So.
Sure. That's a lot to cover, but so I've been in the investment business for a little over 15 years. I started as a trader over at the Chicago Board of Trade. So I did that for over a decade and then made the transition over to long-term investing around 2018. And so I joined Left Brain at that time and joined as an analyst with Left Brain and have moved up to the director of research. And I'm also an advisor now with the wealth management business. And we have a passion at Left Brain, and that's for educating the investing public. And that's for, the people that work with us, our clients, and also the broader investing public. And we have a little bit of a different take on investing. There's a lot of passive investing out there. And we're a wealth management company that focuses almost exclusively on investments and security selection. And so I would say that's our calling card. And I'm happy to talk more about that as we go through.
Yeah, that's fine. I think there's always an argument between passive and active. I'm a fan of both, actually. So it's matching the right strategy for the individual circumstances and obviously their approach and what they come through with as well. So how do you, when you first obviously see a client, a new client, for example, what is the approach that you take to understand what they are looking for and obviously what is the best strategy to adopt for them?
So we have an investor questionnaire that we begin with any prospective client, and that just gives us sort of an idea of their risk tolerance and their attitudes towards risk. And then we just use that as a starting point. So, risk tolerance, there's two components of that. That's willingness to take risk and ability to take risk. Okay. And, what happens a lot of times is people who are not very well versed in finance and investments, their tolerance for risk and their willingness to take risk kind of diverges from their ability to take risk. Yes. And so, it begins with education right off the bat, which is, we understand sort of your attitudes towards risk, but the reality is you have the ability to take more risk than maybe you think or you might have conceived of to begin with. And so it all begins with education. And then in educating them in the way that we pursue investments. I would say on the average, we're a little bit more aggressive than most wealth managers, both in terms of asset selection and the security selection. So where a lot of companies will have their people in 60-40 portfolios, 60% stocks and 40% bonds. We're going to be a little bit more aggressive. And of course what matters is, their situation. It really does dictate exactly how we go. But I would say on average, we're going to be a little bit more aggressive than most. And the reason that we're able to do that is that we have such a strong research presence, a group of 5 analysts. And so, we're not just getting in the market and hoping for the best. We're watching the positions that we take and keeping an eye. And so that allows us to keep concentrated positions as well. We're not the biggest fans of diversification. We're willing to take on a position, that starts maybe 2 to 4%, but might grow into almost 10%. But as long as we have our finger on the pulse of that situation in that business, we're happy to keep that allocation and not really worry about rebalancing like a lot of others would.
You certainly seem to be back in the trend, certainly in terms of what we would do in the UK. Diversification is obviously key for us, or the strategies that we adopt certainly in the UK. And so it's interesting to see how you specialize and have a more aggressive stance in obviously your firm. So I'm assuming then in terms of performance, then the performance obviously justifies more of aggressive stance that you take.
It sure does. And, we take a novel approach to this business. We see a lot of advisors out there that are, passively managing and what are they really providing to their clients? In a lot of cases, it's just, you know, taking on a fee to put their clients in a number of mutual funds.
Yeah.
And, you know, from a business point of view, we run completely the other way from that, because, you know, from our point of view, how are we going to be able to charge a premium fee if we don't provide that premium service?
Yeah.
And so, you know, we do all the financial planning that any other advisory firm would do, but we really try to differentiate by doing this active management, which has a foundation in research and a rigorous process. It's
an argument which is growing very much in the UK, where exactly the points that you've raised, where it's a question of advisors charging fees for a passive approach, where many clients, you could argue that they don't need an advisor in the mix when they're in the accumulation stage if you're using passives, because obviously there's lots of portfolios out there that you can use and self-select, and you don't necessarily need an advisor. But again, going back to the point that you made, is where we are different in terms of wealth management, is that the financial planning is where that adds the extra, if you like, benefits to the client. But you are in a position where you're able to do both in left brain. So you've got a different strategy in terms of the investment side, but you're also marrying that up with the financial planning aspect as well. So,
of course, you know, that's the core of what people are asking us to do as advisors, is to, you know, plan their financial life going forward into retirement, you know, and paying for education and leaving something to their heirs. And that's what we're really interested in doing. You know, and they're basically, it's a simple equation for wealth management. You know, it's how much can you save? It's what are your goals? And then what can you generate in the investment returns? And kind of like how we've talked about a little bit before here, we really focus on that investment part, because, you know, doing some research and doing some calculations, you'll quickly come to realize over a long term, you know, 20, 30, 40, or 50 years of an investment life, if you can just generate, you know, 2, 3, or 4% more per year, it's just incredible what the power of compounding does to really make those returns more exponential over that time frame. And so that's the why for us. You know, if we can just find a way to be incrementally better than our competition, we can help our clients really achieve something special. And so that's why we spend so much time, energy, and resources on investment selection and investment research.
It's something that the general public don't always understand, the power of compounding. You know, it's often been described as the eighth wonder of the world, and you know, you and I understand that fully. But as you say, that compound effect over a long period, which most people invest for, in reality, very few people invest for any short time, and it's usually, you know, or often 5, 10, 15, 20, 30, 40 years even. I've got clients since I first started nearly 35 years ago, and they are still invested. So people's investment journey lasts a long time. And as you say, if you can either get slightly better returns than anybody else, or you are able to have, should we say, lower charges without compromising performance, then it makes a huge difference as the years go by in terms of how that money grows.
Right. And again, like I said, from the business point of view, we worry about other advisors, and that's why we have this investment research service, because we're trying to teach advisors there's a different way to do, you know, rather than trying to just index and go along, you know, conservatively. If you can find a way, and it takes some effort and resources, but if you can find a way to be more active, and as well as long-term oriented as well. We're not talking about in and out trading. We're talking about long-term investing in world-class businesses. But, you know, you've been in the business a long time. You understand, if you can find just 2, 3, or 4 tremendous businesses and just ride those for 20 or 30 years, that's really all you need to do.
Yeah, no, absolutely. So are you looking for, when you're choosing investments, are you looking at a particular sector or a size of company, or are you looking at the fundamentals in terms of what that business looks like and what potential is?
So we're fundamentally oriented. And so we're a bottom-up firm. I've said before, we're a bottoms-up firm. It's a little bit of a different connotation. No, so we're fundamental. It does lead us to certain sectors at certain times, but we are generalists. But we're looking for a certain, I'd say 5 or 6 characteristics in whatever we're looking for. Of course, stock performance is important, but what really wins out in the long run is world-class businesses.
Okay.
And so we're very growth oriented. And so I just want to share a few of the characteristics that we look for.
Yeah, that's fine. I was going to ask you that question anyway, so please do.
Sure. So the most important thing, especially in growth stocks, is the trajectory of sales growth, or what we call revenue growth.
Yeah.
And what we try to coach our analysts to tell us about when they look at a company, when they research a company, is if they see an accelerating revenue growth trend. That's the most important number one factor we're looking for. So if you see, of course, we want to see growth in the 30s or 40%. But if you see it going up over the last 3 years, you're seeing something really playing out, a thesis playing out in the marketplace that tells you this is a business on the rise. So that's number one for us. And then along with that, you know, in 2000, a lot of people lost out on growth stocks and in internet stocks because these companies didn't have a profitability trajectory at all.
Yeah.
And so we're looking for some sort of a risk management tool in terms of growth stocks, because there are stocks that are growing in the 50s or 60s, but losing a ton of money.
Yeah.
And we tend to shy away from those for the most part. So we're looking for a company that's profitable on some metric. So we have 3 or 4 metrics that we look at, you know, EBITDA or free cash flow. So we're looking for that to be the case, or at least a trajectory toward that. So that's sort of our risk management. And then more broadly, we're looking for category defining companies or category killers. So a lot of the times in growth stocks, you're looking at companies that are, you know, challenging the status quo. So, you know, in the technological space, you'll see a lot of companies that are trying to compete with an Oracle or an IBM or somebody along those lines. And so we're looking for companies that are trying to disrupt the existing order and create something completely new. And that's something we really love. And again, kind of along those lines is benign competition. We want to be in growing markets where there are fewer competitors. So it just gives us many more ways to win. And then the final characteristic, and I think after sales growth, this is the second most important, is management. We love companies that are run by founders, founder CEOs. And there are a number of reasons for that. The first is they understand the DNA of the company. And so they're going to run the company with a visionary concept, more so than sort of these professional manager CEO types. So that's the first reason. And the second reason is it's the alignment of interests. Yeah. What you'll notice is with founder CEOs, they tend to have the lion's share, if not all of their wealth in that stock alongside with you as an investor. And so that gives us, you know, all the more confidence that company is going to do right by shareholders, because the number one shareholder often is that CEO or founder. So those 5 characteristics really are kind of a through line between all the stocks that we choose. And then kind of want to give you a little bit of a sense. Like I said, we're not sector focused necessarily by design, but in the case of growth stocks, you'll see a lot of, you know, the technology, IT, communication services companies in our book, because they're the ones that fulfill these criteria more than any other.
Okay, so I'm assuming based on that, then asset allocation plays less of a part for you guys?
To a degree. Like we say, it's different for every client. And, you know, of course, as clients get older, they tend to need more income.
Yeah.
And so we're actually active selectors on that side too. So if we have a bond allocation for a client, we don't usually put them in bond funds. We do select individual bonds. I mean, we tend to work more in the high yield space, especially now with as interest rates as low as they are. That's where we really need to look to find yield. And again, our risk management process is our research process. So we need to have visibility and understanding of how a company is operating. And in the high yield bond space, these companies are usually turnaround candidates. Yeah. And so we really want to know the story inside and out before we put, you know, clients into individual bonds. because one individual bond might be 3, 4, or 5% of their bond portfolio. So a default would be very, very injurious to them. So it's important for us to use that discipline of our research process to drive things. And then one more thing I'll say on that is, again, with interest rates as low as they are, the bond opportunities have been diminishing relative to what they have been in the past.
Yeah.
And so we're starting to look more toward what we call bond-like equities, which are stocks that pay dividends or cash flows out to investors on a time frame where we feel comfortable with the cash flow that drives that, and we feel safe with those dividends. So we're looking for income securities more broadly now than just bonds.
Yeah, it's a trend I'm seeing more in the UK too. So in terms of the portfolio that you will construct for your clients, what's the sort of numbers of holdings would you have in there? Would you have, you know, a relatively narrow range, or would you have, you know, how many holdings would you have in a portfolio typically?
So we definitely express that thesis of active selection. So we don't want to be closet indexers. We don't want to have 100 or 200 stocks and then really sort of whittle away the edge of choosing securities. And so what we have something called the long-term growth model, which is kind of the basic portfolio that we use. And then we of course customize it, you know, for each client. But for the most part, we're going to hold anywhere between 30 and 40 stocks.
Okay.
And from my point of view, and especially folks that are in the accumulation phase of life, so in their 30s, 40s, we really don't like to sell stock unless there's one of two things happen. Our business case thesis changes. So we, you know, read a couple of conference calls and something's changed, or we may sell if a better opportunity comes along. So there's a limited capacity in there for, you know, 30 to 40 stocks. We find new opportunities every month. So we're always sort of reevaluating the companies that we would say kind of are in the bottom of that 30. So, but in terms of turnover, it's fairly minimal.
Yeah, well, again, that's having, if you like, the strength and belief in your strategies, and obviously how you select stock. So why would you, you know, hold them for a short term if you fully believe in that firm that you are, or the holding, or the stock that you buy in for the long term? It's going to be in the odd one that something comes out of the woodwork that nobody's expecting for you to change direction with these.
Yeah, of course. And, you know, I think I have some perspective of this because I was a short-term trader for such a long time. And, you know, of course, when you're young, it seems like the thing to do, and your patience isn't what it is later in life when you have more experience. But, you know, there's of course tax consequences to turning over your portfolio. And not only that, what I realized is when you go in and out, you have to make so many more correct decisions. When I buy a stock for 10 years, I've got to make the one decision to enter and basically the decision to exit at the end. And so what I realized is it really puts the game more in our favor if we don't make as many decisions. I think, you know, most decisions that are made in the market are wrong decisions, and we want to help our clients caution against that.
They knee-jerk reactions in many cases. So, you know, you're always going to have to fine-tune investment portfolios as time goes by, because, you know, things change. But I agree with you, the core of what you have should be based on the fundamentals, on the approach that you take. And, you know, you need to stick with that because it's the long term that you're looking at.
That's right.
I'm interested in hearing more about the education side, because we both have a passion for educating our clients, and I do it mine in many different ways. But tell me how you yourself and how Left Brain approach this with your clients.
So there are a number of ways that we educate clients and also broader investment public. But we talked before a little bit about risk appetites and educating clients about what risk they can tolerate and what risk they ought to be taking based on their circumstances. So that's one. The other thing is emotional control. You know, it's very difficult, even for professionals, the way that the markets move. it can be very emotional, especially when markets fall. And, we all have a plan. We want to buy lower and sell higher.
Yeah.
And the reality is when markets fall, it feels horrible. And while we intellectually understand that we need to buy at those times, when push comes to shove and it's time to do that, it feels awful and it's very hard to do. And what happens is a lot of the time, of course, clients will call in down market times and express emotions and, concerns,
Yeah.
which is obviously understandable. But we want to help them through those moments. And, the reality is especially with growth stocks, it's hard to buy growth stocks at a price that you feel comfortable with.
Mm-hmm.
And so the way I view it is when markets fall, it's actually an opportunity to actually gain exposure to the stocks you've been looking for all these years or for a long time. And the problem is, especially with financial media, it kind of drives you toward that panic side of, really, like you said, knee-jerk reactions when markets fall. And, it really clicked for me a couple of years ago is that when you change your mind frame and you realize, actually, I may be invested and, on paper, my wealth may have gone down over the last few weeks. It's actually a tremendous opportunity to add stock, especially if my context is if I'm looking for 20 or 30 years down the line to retire.
Yeah.
Wow. I mean, it's just such an opportunity to buy the stocks that you wanted. And again, it's so hard to do in the moment, but again, it gets so much easier each time that you do it because you get that feedback. The first time that you jump in and take that risk and you start to see returns coming from that, the next time the market falls, well, it gets that much easier to do it. And so that's the sort of education that we want to put out to our clients, especially in the hard times. And then finally, on our investment research business, we're trying to educate as well. We're trying to educate professional advisors as a different way to do things. And also we have some educational pieces that are just trying to explain some of the more fundamental concepts of investing. So we want to help anybody out there that's trying to invest. We think there's a better way than just putting into the S&P 500 index or FTSE or what have you. And, we want to drive not only people that we work with, but others toward that method of investment.
Investments or investing should be fun as well. And just following an index isn't necessarily fun. You might get obviously decent returns, but you're not learning anything. With working with you or I, for example, in the wealth management space, then if you have a good advisor, or investment advisor or financial advisor, then you're going to learn so much along the way when you're working together. And the things that you've mentioned, and this is where we provide support, and you certainly do the same, is when we have these world events, and I've experienced quite a few of those over the last 30 years. So you have the confidence that you've seen it before, and if people can hold their nerve and not panic, they can benefit very much from staying in the market rather than coming out of the market at the wrong time, because you can't make it up, as we both know, if you come at the wrong time. But also, as you said, and again, very few people do this, but it's always wise to have some liquid cash available, because these opportunities do come along. They may not come around every day, but they do come around every few years. And if you can make big returns in a relatively short space of time.
What's funny, Tony, is at Left Brain, we've had this experience where, of course, we've been trying to educate clients for a long time. My boss has been working with clients for over 20 years. We started in 2014 in our current iteration. But what we find is we get a lot less calls of, hey, this is, we're feeling panicked, we want to sell. After a few years working with folks, what tends to happen now is they'll call us up and say, wow, this seems like an opportunity to jump in. And then that's when you've really done your job of educating.
Yeah, that's a perfect example of educating people in the right way. And it's nice when people can make their own decisions because you have shared that knowledge with them and understanding where they probably wouldn't have had that if they hadn't been using an advisor such as you or I. So,
right, and I'm sure you know, the most money you're going to make in the market is buying those dips. It really is.
absolutely.
You know, if you set out and do the math, like you said, if you're out of the market in those times, you're going to shave off so much of your return. And it's so important and so critical, whether it be to try to jump in and buy in those dips, or whether it be having an investment strategy where you just put the same amount of money in every month. That's another way to sort of fight against that panicking problem. And, you know,
cost averaging it.
Yeah. You know, we all know that market timing is the hardest thing to do in investing. And it's sort of an ego thing, to be honest. And the sooner we get away from that ego of, hey, I want to make a great decision, I want to buy the bottom, I want to sell the top, the better off you're going to be.
Investing is also a habit as well. If you can create a habit where you are investing on a regular basis, and as you say, with the pound cost averaging, it's such a stress-free way of investing, as long as you're investing wisely and in the right portfolio, which again, with your support and my support, people are able to do that. It's fascinating in terms of, I don't know if you get it in the States, but we have lots of stats in terms of clients being better off with advice or without advice. And the emphasis I'm seeing at the moment is that clearly where somebody has taken advice from an advisor or a financial advisor or investment advisor, they are obviously, in most cases, much better off than they would if they hadn't. But there seems to be an element at the moment that costs are more important. My belief, I don't know if you share the same, but I'd rather pay a little bit more for advice, knowing that my money is safe and secure and in the right place, certainly in the long term, rather than knowing I'm getting a lower cost investment portfolio, which may or may not perform as well.
I agree. I think it's a nuanced conversation. I understand those who are advocates of passive investing. Like we said, there are advisors that aren't providing a service commensurate with the fee that they charge. Yeah. And in that case, the fee is really a drag on your wealth building. But what we do, and like we say, with our subscription service, we want to teach advisors as well, there's a better way. You know, we want to be able to charge a premium fee. And there definitely is a way to invest where you provide value and you don't feel bad about charging that fee. And that way is active management.
Expand, you mentioned subscription service a few times. So expand what that means for you at Left Brain.
Yeah, so at Left Brain, we have, of course, the wealth management business, and we have some other affiliated investment businesses. And like I said before, we have always had a research staff in-house. So we do our own research. We don't look to sell side research from our brokers or what have you to try to make decisions. Yeah. And so, you know, we've read the quality of the Wall Street research, and we know it's sort of lacking, especially if you're trying to make, you know, strong decisions. Yeah. And so, you know, again, it's a costly endeavor to have a research staff online. Okay. And so what we decided was, hey, we know there's other advisors out there like us. Yeah. That need research, that are, you know, they don't love the Citigroup research that comes over from their broker isn't great, and they need help to make decisions and you know, create a more sustainable business model going into the future. And so we have the subscription service out there where what we do is we put out the exact research that we use in-house to make all the investment decisions. Okay. That's now available to the public in a subscription service, and that's at leftbrainir.com. And you know, it's targeted toward advisors, but it's also appropriate for, you know, there are those high net worth people out there that are doing their own thing. It's appropriate for those folks as well, because you got to have some basis, again, to make these active decisions, rather than just saying what was said on CNBC. That's not enough.
I think it's a great approach to be able to serve a number of different communities, really. So you're supporting other advisors, you're supporting self-investors effectively. And also you were using that research yourself to create these portfolios and wealth for your own clients.
That's right.
We're coming towards the end, so there's one question I always like to ask all of my guests, and I think it's probably even more appropriate for you because we are both in the same or in the similar space. So the question I always ask is, what does wealth mean to you?
Sure. You know, I have my own individual understanding of wealth, but I think it's more important to talk about it sort of in the context of our experience at Left Brain. And, you know, we have, of course, some high net worth individuals, but we also have some more everyday clients as well.
Yeah.
And, you know, for me, wealth building is all about achieving goals. And, you know, a lot of people come to us and they're just looking for a retirement and dignity. And of course, that's what we want to provide them as a baseline. But what's so exciting about kind of the way we approach investments and how things play out is sometimes the goals change over time once they realize, hey, the investment return is changing the math on how I can retire.
Yeah.
And for me, that's the most exciting part of this business and part of our firm in general is, you know, people doing things they never imagined in life, you know, being able to provide education for grandchildren or leave something behind where they never thought that was ever possible. And, you know, one of the things I always talk about with people with growth investing is a lot of the mistakes people make in growth investing is selling too early because it's a failure of imagination of what can really play out if a business case plays out the way that you thought. And so I like to talk about that as well as imagining the possibilities of what you can do with your wealth if you can just gain that incremental return. And so that's what we do every day at Left Brain. We're really focused on, you know, taking folks that, you know, may have apprehension about what may come in the future and doing away with that, taking away the anxiety, and then helping them achieve dreams they never thought possible. So that's how I really look at wealth building.
What do you ended on a great note there, because again, I'm a retirement specialist, so there's no better feeling for me as an advisor to see the look on somebody's face when they realize that they can achieve the life that they want in retirement, and often far earlier than they ever dreamed possible. And I think that's, for me, that's the reason why I do what I do. It's the main reason for me.
Absolutely. You know, there are a lot of professions you can do to change people's lives. This is one of them, and we really appreciate the opportunity that our clients give us to help them achieve those goals and dreams. And like you said, there's no better feeling than taking someone from that journey of anxiety of what retirement might look like, and then taking them to that level of security. I mean, that's what Left Brain's all about.
Yeah, I think we both very privileged to have people that trust us to help them do this.
Yes, sir.
Brian, if people or anybody wants to work with you at Left Brain, how do they get in touch with you? What's the best mediums to get in touch with you?
So there are a few. You can find us, first of all, the wealth management business. If you're looking for an advisor to work with to help you achieve your financial goals, you can find us at leftbrainwm.com.
Okay.
And then, of course, if you're looking for that subscription research, leftbrainir.com.
Okay.
And then finally, I'd like to send this out to anyone I talk to, is folks that listen and want to get to know more about what I have to offer. Feel free to reach out to me on LinkedIn, Brian Dress. I'll be happy to answer any questions you have. I love talking about investing and retirement goals, and willing to put myself open on that platform as well.
All right, that's great. I will put these links up on the show notes, so anybody who's then going to listen in, they can pick up these links to you as well. So, Brian, it's been a pleasure to speak to you today. I've really enjoyed it, and I'm sure my listeners will as well. So thank you so much, and I wish you well in everything that you do.
Thank you, Tony. Same back to you, and It's been a pleasure being with you and both you and your audience.
Thank you very much. Take care.
Thank you.
Bye.